All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not financial doom porn for clicks. This is about a quiet policy framework that has already been adopted by financial regulators in over 24 jurisdictions worldwide, including the United States, the United Kingdom, the European Union, and Australia. I'm talking about bail-in legislation. And if you don't understand what that means, here's the bottom line. Under this framework, when a systemically important bank fails, your deposits above the insured limit can be converted into equity to recapitalize the institution. You heard that right. Your cash savings, the money you think is safely sitting in your checking or savings account, can legally be used to save the bank. You go from being a depositor with a claim on your money to being a creditor, or worse, a shareholder in a failing institution. This isn't coming. It's already here. The Financial Stability Board, the Bank for International Settlements, and the Federal Deposit Insurance Corporation have all signed off on this. The precedent was set in Cyprus in 2013, refined in Italy in 2015, and codified into law across the G20 after the 2008 financial crisis. And here's what's critical. We are now entering a macro environment where the probability of needing these mechanisms is higher than it has been in decades. Global debt to GDP ratios are at all-time highs, central banks are trapped between inflation and insolvency, and the traditional tools of bailouts and quantitative easing are politically and fiscally exhausted. That means the next crisis will not be solved by printing money and bailing out banks with taxpayer funds. It will be solved by bailing in depositors. In this video, I'm going to walk you through exactly how this works, why it's not just legal, but inevitable, and most importantly, what you can do right now to protect your wealth and position yourself asymmetrically for what's coming. By the end of this video, you'll have a clear action plan, so stay with me because this is not a drill. Let me introduce you to a concept that will frame everything we discuss today. It's called asymmetric wealth preservation, and it's the only rational framework for navigating systemic financial risk in an era of unprecedented monetary experimentation. Here's how it works. In a traditional investment environment, you're balancing risk and reward in relatively stable conditions. You diversify across stocks, bonds, maybe some real estate, and you assume that the rules of the game stay roughly the same. But we are not in a traditional environment. We are in a regime where the rules themselves are being rewritten in real time, and most investors have no idea it's happening. Asymmetric wealth preservation is about recognizing that in a system under extreme stress, the downside risk of staying in traditional financial instruments, particularly unsecured bank deposits and long-duration bonds, is catastrophic, while the upside of moving into hard assets, physical precious metals, and decentralized stores of value is exponential. The asymmetry comes from the fact that your risk is capped at what you invest, but your protection is absolute. If you hold physical gold and silver, no regulator, no bank, and no government can convert that into equity in a failing institution. It's outside the system, it's final settlement, and in a world where financial repression, negative real interest rates, and bail-in frameworks are the new normal, that's not just smart, it's essential. The thesis of this video is simple. We are at a critical juncture where the probability of a major banking crisis is rising. The tools to resolve that crisis have shifted from bailouts to bail-ins, and the vast majority of investors are completely unprepared. But here's the opportunity. Those who understand this shift and act now can not only protect their wealth, but position themselves to benefit from the largest wealth transfer in modern history. This isn't about timing the market, it's about understanding the rules of the game and playing a different game entirely. So let's break this down, starting with history, because this has happened before, and the patterns are unmistakable. The first historical parallel we need to examine is the Great Depression and the banking panic of 1933. Most people remember the stock market crash of 1929, but the real systemic crisis happened in the banking sector between 1930 and 1933. During this period, more than 9,000 banks failed in the United States. 9,000. And here's what's critical. Those failures weren't just about bad loans or poor management. They were about a fundamental mismatch between the promises banks made to depositors and the reality of fractional reserve banking. When depositors lost confidence and rushed to withdraw their money, banks didn't have the liquidity to meet those demands because the vast majority of deposits had been loaned out or invested in assets that couldn't be sold quickly. The result was a cascade of bank runs that destroyed the savings of millions of Americans. Now, the government response to that crisis was twofold. First, they created the Federal Deposit Insurance Corporation, the FDIC, to insure deposits up to a certain limit and restore confidence in the banking system. Second, and this is what most people forget, they confiscated privately held gold. Executive Order 6102 signed by Franklin D. Roosevelt in 1933, made it illegal for U.S. citizens to own gold bullion or gold certificates. The government forced citizens to sell their gold to the Federal Reserve at a fixed price of $20.67 per ounce, and then immediately revalued gold to $35 per ounce, effectively devaluing the dollar by 40% overnight. This was a wealth transfer from savers to the state, and it was done under the guise of economic emergency. The lesson here is clear. In a systemic crisis, governments will rewrite the rules, confiscate assets, and devalue currencies to protect the financial system and the state itself. And if you think that can't happen today, you're not paying attention. The second historical case we need to examine is the stagflation crisis of the 1970s, because it's the closest parallel to the macro environment we're entering right now. In the 1970s, the United States faced a toxic combination of high inflation, stagnant economic growth, rising unemployment, and collapsing confidence in the dollar. The Bretton Woods system, which had pegged the dollar to gold, collapsed in 1971 when President Nixon closed the gold window and ended the convertibility of dollars into gold. What followed was a decade of monetary chaos. Inflation peaked at over 14%. Real interest rates were deeply negative, meaning that anyone holding cash or bonds was losing purchasing power every single day. The stock market went nowhere for over a decade in nominal terms and got destroyed in real terms. And here's the key. During this period, gold went from $35 an ounce in 1971 to over $800 an ounce by 1980. That's a 2,200% return. Silver went from $1.50 to $50. Why? Because in an environment of currency debasement, negative real rates, and collapsing confidence in fiat money, investors fled into hard assets. They understood that gold and silver weren't investments in the traditional sense. They were insurance against systemic breakdown. They were a store of value that couldn't be printed, debased, or confiscated by decree. And here's what's critical. The investors who positioned themselves in precious metals before the crisis fully materialized didn't just preserve their wealth, they multiplied it. They capitalized on systemic dislocation. The lesson from the 1970s is that when central banks lose control of inflation, when real interest rates go negative, and when confidence in fiat currency erodes, precious metals become the single most asymmetric trade available. And we are seeing all of those conditions reassert themselves right now. But let's bring this into the present. Let's talk about Cyprus in 2013, because this is where the bail-in framework was tested in the real world for the first time. In March 2013, the Cypriot banking system collapsed under the weight of bad loans and exposure to Greek sovereign debt. The government needed a bailout, but the European Union and the International Monetary Fund imposed a condition. Before any external funds would be provided, Cyprus had to raise capital internally by confiscating a portion of bank deposits. Here's what happened. All deposits above 100,000 euros in the two largest banks, Bank of Cyprus and Laiki Bank, were subject to a haircut. In some cases, depositors lost up to 60% of their savings overnight. Those funds were converted into equity in the banks, which were essentially worthless. Depositors became shareholders in failed institutions. They went from having a senior claim on their money to being junior creditors in a bankruptcy process. This was not a rogue action. This was a coordinated policy decision endorsed by the European Central Bank, the IMF, and the EU. And it worked from the perspective of the regulators. The banks were recapitalized without a direct taxpayer bailout, and the systemic crisis was contained. But here's the critical point. Cyprus was the template. After 2013, the Financial Stability Board, which coordinates financial regulation for the G20, formalized the bail-in framework as the preferred resolution mechanism for systemically important banks. In the United States, this is embedded in Title II of the Dodd-Frank Act. In the EU, it's the Bank Recovery and Resolution Directive. In the UK, it's the Banking Act. These laws give regulators the explicit authority to convert deposits, bonds, and other unsecured liabilities into equity during a resolution process. And the threshold for what qualifies as a systemically important bank is lower than you think. We're not just talking about JP Morgan or Bank of America. We're talking about regional banks with tens of billions in assets. Now let's connect this to the current macro environment, because the conditions that make bail-ins not just possible but probable are all converging right now. Start with global debt. According to the Institute of International Finance, total global debt, public and private, is now over $315 trillion. That's over 330% of global GDP. The United States alone has a federal debt of over $35 trillion. And when you include unfunded liabilities like Social Security and Medicare, the real number is closer to $200 trillion. This is not sustainable. Central banks know this, governments know this. But the political will to address it through austerity or default doesn't exist. So what's the alternative? Financial repression. Let me explain what that means. Financial repression is a policy framework where governments and central banks deliberately keep interest rates below the rate of inflation, forcing savers to lose purchasing power over time while reducing the real value of government debt. It's a stealth tax. It's a slow-motion wealth transfer from creditors to debtors, from savers to borrowers, and from the private sector to the state.